Hello, everyone, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. I'm your host, Cody Laughlin, and joining me, as always, is my co-host, Mr. Brian Alfaro, and we have a very special guest for you today. Brian, why don't you tell us who that is?
All right. Today we have Mr. Neil Wahlgren, Chief Operating Officer of MAG Capital Partners. Mr. Wahlgren brings nearly 2 decades of leadership in operations and capital markets. Prior to MAG Capital Partners, Mr. Wahlgren led a Bay Area real estate investing firm, raising capital for over $200 million in projects. Before that, he piloted the C-130 in both the Air Force and Navy, logging over 2,500 flight hours with combat tours to both Iraq and Afghanistan, and concluding his military career as a lieutenant commander. Mr. Wahlgren resides in San Francisco with his fiance and son and enjoys flying and sailing. He also holds a BS from the Air Force Academy, an MBA from Texas A&M, and an MS from the Troy University. Welcome to the show.
Cool. Thanks for having me, guys.
Absolutely, Neil, man. It's an honor to have you here. Really appreciate your time. And I know we were joking around before the show. It's taken us a couple attempts to get here. So glad it's finally here. But hey, first and foremost, I want to thank you for your service, man. Really appreciate that.
Absolutely,
and,
yes.
We always love and honor our service military men and women. And, I always find it very intriguing. This is really cool. And I don't know if this comes from like a childhood dream maybe, but I love talking to pilots. I think it's freaking cool. Just envisioning you being in the cockpit going 1,000 miles an hour. And I just really think that's cool. But anyway, man, glad you're here. Tell us a little bit about your background and how you got with us today.
Yeah, absolutely. So, Brian covered the high points there. So a very, pivoted approach to commercial real estate. But one thing I kind of like about the field is I feel like very few people just jump straight from school to commercial real estate. And I mean, almost always you have some deviation. Sometimes it's within the field as a, broker or a realtor, but quite often people do very different things first before they kind of circle back in. I think the flying side is no different, but it was good. It really, for me, my takeaway was how do I take, what I've learned in the military flying world and how do I, kind of apply that to, something that really kind of resonates with my passions and a lot of that. I mean, everything from the structure of, how, a pilot treats flying an aircraft. I mean, very checklist driven, methodical in terms of how you approach a deal, how you value it. I mean, you're doing the same things over and over and over. And that repeatability, in my opinion, is what allows you to really, hone your craft and get very good at the niche that you play in there. So that was probably one of the bigger takeaways from that. But yeah, really enjoyed the transition from, more of a hands-on career field where, your value and your earning potential was directly tied to the hours you put in to, kind of switching over to the investment side. I mean, you guys have probably either read Rich Dad, Poor Dad or, familiar with the concepts there. Most people in our field are. And, I read it and I loved it. And I love the idea of, hey, I can transition myself out of basically being an hourly employee and, allow myself to be in a field where I can, really grow value and do something good, improve real estate, improve its tenants, and do it in a way that's not tied to the amount of hours that I'm putting in directly.
Well, I love that, man.
That's
I think that's great. Yeah. And you've mentioned so many great things about, as coming from the military background that you have and having that discipline and that structure, which I think is very important as a real estate entrepreneur, because it takes a lot of that just to build the foundation of your business. And then, as you mentioned, your motivation behind trading that time for money and getting away from that, which I think most of us can resonate. I think that's kind of why all of us are taking on this path, right? And it's funny you mentioned Rich Dad Poor Dad. I joke, I call it the purple Bible, because I mean, there's really not any other real estate book that I know of that has impacted so many millions of people over decades, and it resonates with people now. Even versus when it was put out in 1990s or whenever it was. But nonetheless, man, yeah, I really love that. So
quick aside, He
Yeah,
actually, the author, Robert Kiyosaki, was a Marine pilot back in the day.
yeah,
So
yeah,
it kind of has that same, a bit of that methodical approach, combined with, a certain appetite for risk that comes, I think in the aviation world, but really kind of resonated with him. And I've met him in person, and we've swapped some stories both on the flying side and the real estate side. So I really like him.
Very, very cool. Brian, we went into the wrong profession. We started out wrong. We should have just been pilots from the get-go. And look, we'd already been there.
Cody, I don't know if I've gotten to tell you, but one of my short list dreams is to get my pilot's license. So not my sport license, but the one right above the sport, so I can just take my wife some places. So I always love talking to pilots as well.
It's a great skill to have. So we can chat about it after the show if you want.
There we go.
Little aside myself, but I got a really good friend of mine who's an Air Force pilot as well. And I was like, dude, I would love to do that. Whatever. He looked at me, he's like, they'd never let you in, man. You're too big. Like, I'm 6'2" and 240 pounds. He's like, yeah, you wouldn't make it. I'm like, I was so heartbroken. I was so disappointed. But nonetheless, man, that's really cool. So cool, man. Well, tell us kind of what drew you into commercial real estate in particular. I know you mentioned, again, transitioning from trading your time for money, looking for that passive income stream. But what was it about commercial real estate that really, piqued your interest?
Yeah, so I had a brief chapter working for a renewable energy startup right when I first got out of the service, and really it was entrepreneurial in its structure, and it was early stage enough where there was just a lot of freedom in terms of, hey, here's a new challenge, a new product that we have. How do we build a market for it? And I found myself doing a lot of the stuff unknowingly at the time, but doing a lot of the same stuff that we do as real estate professionals, where, we were looking at markets, we were looking at demographic data, we were looking at our customer segment, and trying to find what kind of value can we get for this product. Not so different than, say a multifamily project, looking at what kind of value in rents can we get for this product, in the same type of market there. So ultimately, I moved up to San Francisco about 6 years ago and had the opportunity to actually join up with a family friend who had started a business some time ago. And his business, it was a great way to dip my toe into commercial real estate because it was equity focused. And ultimately, he was investor focused. And ultimately, the company had a network of investors that we would interface with and raise equity for. And what we would do is, on a deal by deal basis, we would form a JV partnership, typically with a developer or a commercial real estate broker, someone with a high, deep level of expertise in a narrow field that lacked access to capital. So we would bring that investor equity in, and they would handle, basically getting the deal under contract, placing the debt, and handling more of the asset facing issues through the lifespan of the deal. So, with that, I think we had about 7 different operators that we would do multiple deals with. We had one group that specifically did, Class B multifamily in Northeast Atlanta. Another group did, multi-tenant retail in Dallas-Fort Worth area, and et cetera, et cetera. And one of the operators that we raised money for on a couple of deals was Mad Capital Partners. And it was, especially having got to see a lot of different asset types and a lot of different underwriting, and really kind of see, hey, the performance of these projects from inception through the life cycle all the way to sale. I really, kind of gravitated toward the simplicity and the front-loaded value add of a single tenant net leased industrial deal. And so I can dive into it a little bit more here. Ultimately, and what I'll do is I'll try to make it kind of comparative to, say, a multifamily project. And, one of the ways a single tenant net lease structure works is you are effectively shrinking your tenant concentration risk from a wide variety of tenants, that you're looking to potentially increase occupancy, potentially increase rents, and you are coming in and exchanging that for 100% occupancy from day one with built-in rent increases. All of it's built into your lease. And ultimately, the risk really comes down to the credit of the tenant much more than the demographics and the ability of the team to execute on a business plan to increase occupancy. So a very different risk profile, but if done right, an extremely simple, very predictable cash flow stream that just eliminates a lot of the operational risk and uncertainty that you see in more hands-on value add projects.
Yeah, Neil, I like those. We focus on multifamily, but I know a little bit about triple net properties, and I know they're very attractive, especially because they're triple net. A lot of the expenses, most of the expenses are passed on, obviously, to your tenants, and with the exception of maybe some built to suit situations, or maybe getting some capital that you put up for some of the projects. For if you're doing like new builds, it's definitely a good investment to make it if you can strategically align with say, A-class institutional partners that, are bringing in the big box brands that are going to attract some of those high quality tenants that are very attractive, the Subways and the other, fast casual concepts that really attract a lot of people. So it's definitely been an interesting last 12 months where it's kind of changed that demographic for triple net properties. But I still think long-term, those are very attractive asset classes.
Absolutely. Yeah. And, it's helpful for some of the listeners to understand, triple net are increasingly becoming common on multi-tenant retail. So historically, they were usually gross leases where, the landlord would absorb a lot of those expenses, and really pass on some of that risk the landlord has taken on by, ultimately a higher price per square foot rent in the form of a gross lease. And more, landlords have been transitioning over to, as leases renew, they'll replace them with a full triple net lease, such that the tenant's responsible for, the taxes, the insurance, utilities, maintenance. And that way, the tenant really keeps control of their own expenses in a way that's a little tighter. They get a lower price per square foot in exchange for that, ultimately responsibility for those expenses. And on the flip side, the landlord doesn't have to worry about, hey, if the tax assessor comes in tomorrow and doubles my, my tax rate here, is that really going to just kill my whole profitability? No, that gets passed on to the tenant. The same goes with insurance premiums doubling, with, a crazy, utility rates doubling. Even take Texas, after this last, really, really nuts ice storm. I don't know if you were reading, but a lot of these utilities were actually on somewhat of a demand fluctuating basis. So some of these.
Oh, we know.
Oh, so yeah,
we lived it.
So, and I've just been reading stories about, multiple $1,000s of electricity bills for, single family homes. And I mean, it's kind of wild, but.
Yeah, we're based out of Houston. We know too well about that.
Yeah, I'm preaching to
so
the choir here.
I want to kind of go back. I want to go back and kind of highlight a few things. And just for any listeners that may be tuning into the show for the first time, as Brian mentioned, we are focused on multifamily, but I think this is a very timely discussion because if you know anything about the multifamily space, I would argue commercial real estate in general, but in particular with our focus on multifamily, that, with the amount of liquidity that's in the market and with the, amount of liquidity that's chasing yield and the really lack of available product out there, it's getting harder and harder to get into the multifamily space, especially if you're a newer, younger investor, right? It's very, very hard to find good opportunities. And so when we talk about creating a portfolio of good passive income streams, this triple net is a great investment vehicle that I actually find very compelling myself, and something that we're very interested in. But I want to go back to your point about the tenants. One of the reasons I think a lot of people end up scaling up in the commercial space from single family to commercial is that your risk is higher when you're isolated just to one tenant. Like you have a single family home, your tenant moves out, you got 100% vacancy, right? So people scale up because your risk is diversified. You kind of mentioned the opposite with the triple net spaces, but talk to us a little bit about the quality of the tenants and the difference in the tenant profile in your triple net spaces versus a residential asset.
Absolutely. And, like we mentioned before, really the risk of your investment is tied to the quality of that tenant. So, if you're getting a junk bond level tenant, there's a lot of risk involved, and, you would have a high degree or a high likelihood of that tenant defaulting on their lease and, potentially finding yourself with either a non-paying tenant or a vacant building, which then you'd have to release, potentially incur the expenses with that. So that would be, you would have to have a really high level of income to offset that risk. And there's different profiles of tenant credit risk. So the main two categoric terms are investment grade tenants or sub-investment grade, or sometimes investment grade will be called credit tenants. Credit tenants, as a WAG, usually have over $100 million in revenue, oftentimes publicly traded. They're usually, household names, brand names, and ultimately they are going to have a very low likelihood of default, right? They're going to be your Walgreens, your Amazons, your Subways. I mean, about as sure thing as you can have. The downside of that is with low risk comes low returns, right? So, often owning a triple net Subway or a triple net Walgreens, especially if it's in a major metro, very secure income, but it might only be, 2, 3, 4% a year in terms of cash flow. So what we play in is what's called sub-investment grade. And that is your companies that don't have an outside credit agency. You don't have a Moody's or an S&P giving you a credit score. So you actually kind of have to do that homework yourself. So our typical tenant profile, usually manufacturing firms, they've oftentimes been around 40, 50 years, very historic, consistent profitability. But they do fall below that $100 million investment grade mark. And we like that. And that allows us to build value in that we're able to capture the delta between actual risk and perceived risk of these sub-investment grade tenants. So, we do our homework. We actually create a credit memo on each of the deals. And, this is like, ultimately like a credit score on crack, right? I mean, just imagine, 8 to 10 pages of a deep dive. You're looking at everything from balance sheets to debt loads, quick ratios, financial summaries. And then you look at, hey, what are their plans? You look at their customer concentrations, you're interviewing their C-suite, finding out how they're going to, use proceeds coming in to pay down debt in the future, and at least have a pro forma look on what you think their credit's going to look like over the time frame that you expect to own that real estate. So if you look at that and feel good about it, and there's ways to kind of bolster your security. You can get additional guarantors on the lease. For example, if the credit's lower, you might go to their parent company and say, hey, we'd like a parent company guarantee on that income from the lease just to give us a little additional security. These are ways you can improve that security, but all those are the backing behind the cash flows that come from that triple net investment.
Awesome. Yeah. I mean, the triple net properties, all the stuff you mentioned makes a lot of sense, right? So if if you're leasing up, a triple net property and you're looking to rent, let's say an end cap with a drive-through to Subway or Starbucks or something like that, those are those credit tenants that you really don't have to worry about. They sign those long 30-year leases or whatever, and, they got 10-year options, and, I would imagine they have a lot of pull in lease negotiations as well too. Those guys, they don't play and they know what they want. And it's really interesting actually as well. You actually see a lot of in our area, new construction buildings are actually designed with these tenants in mind. Like, these really smart developers come in and they go, look, Starbucks, 14 to 1,800 square feet, end cap, right-hand side of the street on the morning drive, and they know that this spot, they call them and they're like, we got another one for you. Boom, there they are, right? So it's really interesting to see how that kind of works. But on the other end, I think there's something of value to be able to say, like, there's a lot of people that have small businesses or medium-sized businesses that maybe don't have that kind of credit pull, right? And that's your business proposition that you're talking about, Neil, is talking to those other people that still offer a tremendous, business opportunity or business product or service to consumers, but maybe don't have the, the credit profile, but still want to find attractive spaces and to provide a quality product. So, really interesting, different. I think I look at it like in our space, it's like the A-class multifamily versus like the B-class and the C-class space.
Mm-hmm.
You can make money in all of them, and there's different risk profiles in all of them. I guess it's just more based on what your appetite for risk is, right?
Exactly. Yeah. And you'll find a lot more like institutional money, pension funds. they love the credit tenants, right? Because
Yep.
they need an extremely low level of risk for their constituents, stakeholders. And, for private investors, typically, private investors are willing to take on or seek out some additional risk that comes with a potential for higher returns. So that's really, where do you find that sweet spot? And if you can control or at least identify and mitigate those known risk factors, then you can, in our viewpoint, you can substantially lower the aggregate risk of the overall investment.
Yeah.
Cool.
Again, very, very, very attractive asset type here, and when you talk about commercial real estate and being like a true passive income stream, I think the triple net product type in general is probably the closest you can get to being a true passive investment. I mean, again, you're talking, like Brian said, 15, 20, 30-year leases, and you're passing all over, most of the expense burden to the tenant itself. I mean, it's the closest you can get to mailbox money, I got to imagine, than versus some of the other asset types.
I mean, even so, on a single tenant deal, a triple net lease will usually include even the exterior. So it'll include HVAC, the roof, if you get the roof needs replacement, tenant covers it, even the pavement, the landscape. I mean, you are literally zero expenses. And what's great, when I tell people our operating account, 3 transactions a month, the rent comes in, we pay the mortgage on the debt, and then we pay our investors. And I mean, it's a very, very simple operation on that side.
Yeah. Brian, we're going to have to go and compare profiles, like picture profiles from multifamily investors to triple net investors, and just see who's the happiest. Neil's like got this glow about him. He's got this great hair. He's drinking tea. He's like, life is great. Multifamily investors right now, we're beating our head against the wall. Can't find a good deal.
Yeah, I think that's a great point, Cody. That's a great point, Cody. Neil, have you seen there be more opportunities here in, let's say, the last 12 months with COVID? Retail became very unattractive, and there's obviously a lot of triple net there, but other products like self-storage and industrial, especially due to, shipping and Amazon and different manufacturing, different products like that. Have you found that over the last 12 months that you're seeing more, I hate to call them deals, but better opportunities to find, more products, or are you guys still in the same boat that we're kind of in, where there's a lot of equity floating around, there's a lot of money looking for a home, and it's kind of causing cap rate compression and driving prices up?
A bit of both, and I'll expand on that answer. From a capital side, there is a lot of capital floating right now, and cash is cheap right now, and there's just a lot of capital looking to be placed in something better than an inflationary low interest rate savings or checking account right now. But on the flip side, and to mention the last 12 months, really that's been kind of like industrial as an asset class during COVID, it has really, risen above, where it ever has been before, only by continuing to do what it always does. It's one of the most consistently boring asset classes. You don't have any like wild 25, 30% return industrial deals, and that's okay, because it's not designed around that, right? And that's something that industrial doesn't compete with, say, multifamily, is the upside that comes from a great operator and a great project when it all comes together. I mean, it's beautiful, right? And, it's for the same reason I keep some of my own personal portfolio. I still put about 25, 30% into multifamily, because I like that opportunity if you get the right set of circumstances for, just great returns. But on the flip side, I mean, we had just, as a firm, our portfolio, we had about 23 properties that we owned at the beginning of COVID. And through COVID, we literally, 100% of them paid rents on time. We paid distributions on time. I mean, it was the most steady Eddie, consistent, boring, as planned projects, before COVID, during COVID, and after, in a way that it really attracted people to it. Folks that saw their, say, retail investments, their cash flows were swinging all over the place, and, having that consistency and dependability. I'm not saying it has to be your whole portfolio, but, a chunk of it, as that consistency really goes a long way in an event like 2020.
Yeah, that's a really relevant point. And that's something that I always find particularly most interesting and most appealing about this particular asset type is the quality of the tenant base is such a different it's just such a different profile than multifamily. And the leases, as you've already alluded to, the lease contracts are so much different and structured in a way that really reduces your downside exposure as far as delinquencies, vacancies, whatever the case may be. So, really always have been attracted to that just for that reason. Just like you said, you're talking about major companies that have significant credit worthiness that is gives you some comfort, I'm sure, at night versus,
Oh yeah.
versus like you said, what are we experiencing right now in multifamily in particular? We're seeing a rise in collection delinquencies and vacancies, and people are affected by loss of jobs. And so it's playing a role for sure. But
One
anyway.
one nice thing from the industrial side is you're kind of one step removed largely from end users and end purchasers. And what I mean by that is most of our, a lot of manufacturers are intermediaries. Almost our whole portfolio is companies that make products that sell to retail focused or end user focused companies. And sometimes even with one or two intermediaries in between. So they're making, aircraft parts. They're making, we just bought one that has strictly tubular assembly manufacturing. So they're just making these tubes and automobiles that are used to transfer fluids from, one part to another. And it's a very specific niche. They have a very diversified customer base. And I mean, let's be honest, these are long-term contracts. These are, long established, sales channels and pipelines such that, when things like COVID happen, it doesn't affect them near as much as end user sales.
Yeah. Yeah. Great point. Great point. Well, Neil, I want to go back and talk a little bit about, the holding period, the business plan overall, when you're looking at these spaces, because when you're looking at a 15, 20, 30-year lease, whatever the case may be, is your business model built around that hold period, that being that long as far as a lease? I know in multifamily, again, it's pretty much industry standard, 5 to 7 years, 10 years, is probably the longest you hear most people. What's the strategy like in this space?
Well, so before we get into that, it's important to know how you buy the property. And that really kind of dictates your strategy or what direction you want to go. So there's two ways to buy triple net. One is stabilized, where you're buying, so almost always they're fully occupied. You're buying the real estate in a stabilized deal with a lease in place, and you're essentially assuming the lease as the new landlord, right? And those, it's just more of a traditional sale. What we do is a sale leaseback. So we are buying from typically manufacturing firms. Our standard seller profile is a manufacturing firm that recently sold or got acquired by a private equity group. So they're private equity backed, and that private equity group typically likes to deleverage their corporate acquisition there by doing a sale leaseback. So PE groups don't like owning real estate. So they will sell us the real estate, turn around and sign a brand new 20-year lease. And then they use the proceeds from that sale to kind of deleverage, pay down some of the debt they took on to acquire that portfolio company. And then they'll also use some of the proceeds to reinvest into their new company in a way that positions them for growth over the next, 3 to 5 years. So
that makes a lot of sense. Yeah, it's a very attractive business model when you think about it. It's that velocity of money, right? You even see it in the new construction, right? It's like you build something, you occupy it with a high quality tenant, you immediately sell it. There's some sort of lease back potentially involved. You take your proceeds and you go build another one, or you go buy another one. It's kind of like a revolving door. So it's really smart.
100%. Yeah. And so we're coming in and we like being on the front end of it. So we have a brand new 20-year lease. They got 2 10-year options. Usually that this seller, this, new tenant is, most of the time they've been in place 30, 40, 50 years. So they have no intention of moving anytime. Right. And they usually have a great basis on the real estate. They're paying, we try to structure where they're paying below market rents. If we can structure the deal where, we can keep their rents low, of course, they're going to stay there as long as they possibly can. And that's good. And they like it that way. They have no intention of moving. So we like to hold roughly about 4 to 6 years. And that allows us to still have about 15 years left on that lease. And then that's a very attractive sale to the next buyer. So we don't like to drain out all the cash on that lease. We just take, a healthy cut on the front end, and then we're selling typically to REITs, sometimes private investment groups, even institutional buyers will buy that stabilized asset. It's attractive. It has enough term on that lease where they can hold it a long time without even having to worry about a releasing event.
Great. I like that. So Neil, let's talk about location. And obviously real estate, everything's location, location, location. But for your space in particular, when you're talking about these industrial tenants, probably you're looking at probably pretty large footprints as far as square footage, I would imagine. How do you find what's a good location or demographic area?
Yeah, great question. It's funny for the type of deals that we're buying, swap out location, location, location for credit, credit, credit. And, we do. And it's a bit of a give and take, but, usually the range might be, if we get, say, a medium credit, healthy, but not exceptional credit tenant, we're going to want to couple that with a fairly decent location. Usually we're looking at secondary cities, like Omaha, maybe Lincoln, Indianapolis, those, in or near, the city, or at least within city limits. And then sometimes we're willing to say, hey, we'll take a fairly tertiary location if it's coupled with just a powerhouse credit tenant. If this tenant's doing a couple $100 million a year, sometimes a mothership backed guarantee on the lease. I mean, that's about as sure thing as you can get. And in that scenario, we say, hey, you know what? I'm okay with being 30 miles outside of, the nearest city center, because they're making a core needed product. The market fundamentals are there. But where does that end up? Usually in the Midwest. So we're looking, a lot of Texas, Oklahoma, Missouri, Illinois, Indiana, Michigan, that corridor there. It's nice because you both have, better cap rates relative to the coasts, and that applies to industrial as well. And also from a manufacturing side, most of these guys are distributed and shipping nationwide. So being kind of centrally located in the US just makes sense. It's the shortest distance to both coasts there and everywhere in between.
Yeah. And I'm not as familiar as with some of the northern states you just mentioned, but I know that Midwest here typically tends to be very business friendly, or very tax more lenient, so to speak, for businesses like this. So I'd imagine there's probably some incentive there as well.
100%. Yeah. And I mean, and really, if you're making a B2B type of widget, you don't have a lot of advantage of being located in, LA or, one of these coastal regions. You're probably just overpaying for the real estate, which is affecting your bottom line in a way that's not benefiting your business.
Sure. All right, Neil, let's transition. Let's talk about the debt side of this. I mean, right now, especially in our lending environment in the multifamily space, I mean, debt is incredibly attractive for stabilized assets. What are you guys seeing on this particular side of the fence?
Yeah, unfortunately we don't get agency debt on the industrial side. So there's no, Fannie or Freddie. However, we have seen, I mean, literally in the last 12, 18 months, we watched normal debt interest rates. We were seeing high fours, 4.75, 4.5 was common. And now, I mean, we've gotten a few down to like the low threes, which is fantastic for industrial. One of the big differences is most of the debt in industrial is going to be recourse. So a little different than the multifamily side. So you do end up needing, I would say, a stronger sponsor who has the, ultimately liquidity and balance sheet to sign for a recourse loan on, the size of industrial property you're looking for. So, with that is a big differentiator, and it does kind of eliminate a lot of potential players in the field who just simply don't have the balance sheets to, sign on a $15 million piece of debt there. But, if you have that, it's nice because, you have less competitors in the field and a little more bargaining power when you're negotiating for deals.
And on as far as the equity side, are you looking at, the typical 20, 25, 30% down, or are you having to come in with lower leverage?
If you're doing recourse debt, we're seeing usually about 75% LTV. So we're putting in, 25, 30% equity. If you don't do recourse, there are non-recourse options, but usually on a single tenant deal, most lenders will cap it at about 60%, which, in today's world is hard given how cheap debt is. Usually to be competitive, you need to maximize the amount of debt that you're taking.
Yeah. Yeah. It's kind of interesting. Just as you were kind of explaining that, I was thinking, with the difference in the tenant profile that you guys are seeing. I mean, again, you're looking at, subcredited tenants, if I sub-investment grade in tenants, excuse me, that, again, have a high residual revenue coming in, they have high credit worthiness. It's interesting that there's not more options for an agency type of financing, or maybe some higher leverage, being that the credit profile of these tenants are a lot different than what we're seeing in the residential side.
It is, and it's fascinating. I think my experience is a lot of banks grow and expand their, kind of categories of what they're comfortable and willing to lend on, similar to real estate investors. Almost every bank will give a home mortgage, right? And then, usually the next stage for a real estate investor after they do their, first single family investment, maybe they'll dip their toes in multifamily, and that's usually, the next step for lenders. And then only, when they get more experienced and, start looking beyond that, do they start getting into, some of the lesser known, investment categories like industrial, especially single tenant. And so there's a much smaller subgroup of commercial real estate lenders that even have the experience or team in place to, do their valuation and look at an industrial deal compared to some of the other asset classes.
Interesting. All right, Neil. Well, what's the forecast look like for this space? I mean, obviously there's a lot of discussion, a lot of debate about market trends and market forecast. What are you guys talking about on this side?
Yeah, I mean, there's been some competition with money being cheap. It has been compressing cap rates a little bit. On the flip side, we have seen, especially in the sale leaseback, the whole kind of concept and awareness of sale leaseback as a form of refinancing for owner occupants, especially in the manufacturing space, is increasing. So more and more people are kind of understanding the benefits of it, looking at it, especially ones who, maybe 5-10 years ago would never have considered it. It's becoming more mainstream, which is opening up some, deal flow and supply opportunities on that piece. So I would say those two factors perhaps cancel each other out to some level, and ultimately we're seeing, a healthy kind of baseline level of opportunities without having, massive overpricing that you're seeing in some other asset classes.
Very cool, man. Very, very intriguing. We've had one other guest on the show that's kind of talked about triple net spaces, but from the brokerage side. A while back, a good friend of ours, Mr. Barry Wolf, on the East Coast there. But it's always great to get the perspective from the investor and kind of somebody that's in the trenches from the investment side. But it's been fun, man. Brian, anything else you could think that we didn't ask Neil?
Yeah, the only other question I had was on the capital raising side. This is a very, I would imagine, different investor base. You're targeting a specific, let's say accredited investor, even maybe a non-accredited, but somebody looking for this specific niche. So what's kind of your strategy for attracting capital, and what type of people are you seeing that are more interested in this space?
Yeah, I mean, I would say the majority of our investor base are retail investors and high net worth investors. Our usual investor profile typically has, whether it's a syndication or a small allotment in, 1 to 2 single family, and typically they'll have exposure into multifamily first. And, the way we position this is a great way to augment some of the, I would say higher highs and lower lows of a multifamily investment. And this is, kind of a nice pad, in the same way, if you were going to be all in public markets, you wouldn't just do stocks, you do some stocks and bonds, because on low times, bonds are going to perform consistently or more consistently anyways. And stocks, you're potentially going to see the high growth, but the greater volatility on the downside too. So in general, I think it's a great way to complement the two. I said even myself, I supplement my own personal portfolio with both, because I definitely see the two working well together. And, I think most folks, especially if you've invested in syndications for multifamily, having at least some percentage in industrial is a nice way to diversify there.
Perfect. Perfect.
Yeah, again, that's a great summation, Neil. As multifamily investors, we're very biased on our asset type. We love what we do here in the multifamily space. We probably have a few more wrinkles than you do now, but part of us doing this podcast show is to provide education and resources to help investors make good investment decisions, learn about commercial real estate, and I think this is again perfect timing in that there's probably some people out there that are looking for some alternative investments that, hey, look, that's a good, safe, secure investment, a little bit more predictable than what we're kind of seeing in the marketplace right now. So really, really appreciate the insight and this introduction from the investor level to these triple net industrial spaces. So unfortunately, we're getting near the end of our time, Neil. It's been a fun conversation, but before we go, we have 4 more questions for you, and then we'll wrap up. So,
all right.
One thing that we love to learn from everyone is, what are you doing for your continued education to further your own investing?
Yeah, and I'm in CCIM. So I don't know if you're familiar with that.
Yeah.
Ultimately the master's degree level of underwriting, it's a little painful, but it's been good. And it's the nuts and bolts of a lot of the stuff that I've been, operational in, and kind of to understand the theory and understand the just the foundational pieces, written by decades of instructors and brokers and people in that field, really has, in my opinion, kind of matured my knowledge of, some of the analysis and how we do underwriting in both this space and just commercial real estate in general.
How much longer do you have to go?
I have one more class. So I just finished CCIM 103, and so I got 104 and then final exam. So I'm hoping to have it done by summer.
Best of luck.
Very cool. Very
Thanks.
cool. I know that's something that we, Brian, John, and I, we've all discussed. I think that's definitely on our bucket list to make sure we get done, in the near future. We'd love to go through that. And we've heard a lot of great things about the insights and stuff that you learned through that course. So kudos, man. Best of luck. But
thanks.
So what have been some of the lasting lessons that you've learned along your journey?
Oh man, it's broad. I would say, specific to real estate, one of the big things I've learned really as an investor and on the GP side for positioning investments is understand the unknowns of what's required for your investment to be a success. And I think a lot of people chase returns too much, chase projections too much. And, I've kind of matured personally and, matured kind of how we position our investments to say, hey, invest with operators that look for the unknowns and identify the pitfalls and have done some operational risk management to say, hey, if this unlikely event happens, I at least have thought about it. I have an idea of what I would do. And this is how I would ultimately think I can protect capital. The returns may take a hit. Hey, that's fine. But, at the end of the day, what are you doing to protect investor capital and, to really position your investment equity with teams and groups that have thought about it, have a good plan in place? Because I think, when events like COVID hit, those are the type of teams that excel and, folks that, kind of fly by the seat of their pants a little more, oftentimes get hit a little harder.
Yeah. Yeah. Any advice that you'd give to the listeners to help them grow their businesses?
Just keep learning. The networking side, really, you cannot stress it enough. Build your network. And I feel like that's a broad thing that you can throw out there without having any actionable item. What I will kind of narrow that down to more of a tactical level is when you're looking to place investment capital, use your network to recommend operators in the field that you're looking at. Because personally, I think the team is so critical, especially in these private investment spaces that you and I work in. Find people you trust, find people that have invested in the space that you're considering, and ask them, hey, give me your top 3 operators you've worked with, invested with. And they might not even be the ones that have delivered the highest returns, but I promise you they're going to be the ones who are dependable, who deliver when they say they will, and communicate well. And I think those 3 are probably the most important elements you can look for as, especially a passive investor in really in any commercial real estate asset class.
That is such tremendous advice, Neil. Really, really respect that. Really appreciate that. And definitely completely agree with that, especially right now in this market cycle. You want to make sure you got that top-notch team. It's, good. Well, Neil, tell the listeners how they can learn more about you and connect with you.
Absolutely. We have some resources on our webpage. So Mag Capital Partners is the company, www.magcp.com, or just drop me a line. You can reach me direct at Neil, Neil, at magcp.com. Love to hear your comments, any questions you have on the podcast, or if you're interested in investing in this space, happy to talk more.
Awesome. Well, Neil, really appreciate the great insight. Appreciate the great conversation. Look forward to staying connected, man.
Yeah, Brian,
Thanks again, man.
appreciate having me on. Thanks a lot.
Thank you.